Well, hello and welcome for TokenBrice's Spotlight, a very new show initiating with the Twyne guys in the name of Taulant and Daniele. And so the key concept here is that I'm gonna discover a protocol with you. So I've settled the limit at exactly 30 minutes on my end to document myself about the protocol beforehand. What I did validate is essentially, those guys, if they explain to me what they do, I can explain to you why it makes sense and why we would need this kind of thing. I don't know how it works. I don't know the details of it, but I can tell that there is something of relevance, of value here, if they can figure it out. So that's kind of the concept of the show. We will go into those details as we go through the protocol. Time-wise, I don't know. We booked an hour, guys. I don't know if we're gonna go this long. We'll see how that flows. I'm pretty open on this. Um, yeah, as long as it needs to be, we're gonna go like this. Um, and yeah, let me just double check that we do have something and I'm not talking into the void. And I think we can gently get going. Ta-ba-dum. Do you guys see something like on Telegram, on Twitter somewhere?
Let me double check. Like here, it seems that you're live on Twitter. Yes, I can see it.
On Twitter? Nice.
I can see it on Twitter.
Uh, okay.
Oh yeah. TokenBrice's Spotlight number 1. Yeah, it's there.
Yes, okay. So that seems to be working. So I guess we can start then with the high level. I was saying, I understand why this thing could be needed. I can explain it to people. That's my trial, and then you can take on. But the core idea is really simple and should come forward in 3 sentences. So let me try. Um, Essentially, there is a lot of supply on lending markets nowadays, but not all people are using their whole borrowing capacity. There is a lot of unused borrowing capacity, and this is where Twyne plugs in, because Twyne's offer essentially a solution there where people who don't use their extra borrowing capacity can just resell it, and people who need more borrowing capacity can borrow it, rent it from those first guys, the liquidity providers. So that's pretty much how it goes, and of course the devil is in the details.
Yes.
So we'll get into that. But yeah, from a high level, I got it right. We about the protocol and what it's trying to achieve.
Yes, perfectly right. I mean, it's as simple as that, but it enables quite a lot of cool mechanics down the line. And yeah, maybe also to start with, like thanks for having us as your first guest. We feel honored to be here and happy to go through the protocol and explain you everything in detail.
Yeah, I have a feeling you're gonna need less than half an hour, Bryce.
Yeah, most likely. I was known for marathon, long hours, long format. So yeah, we'll see. Maybe I will spare you guys, not go as deep. And to be fair, I think it's I was doing those marathon on stuff like with a huge ecosystem or protocols that are a bit more mature, I guess. We're in a bit of a more early stage here, so also there is not so much you can do with Twine yet, but we'll talk about that. Yeah.
Yes, but yeah, happy to just walk you through everything. And I mean, I can also reiterate what you were saying. So right now, everybody has the same access to lending markets. It doesn't matter whether you are a lender, a borrower, a pro user, or there are all these different actors at lending markets, but they all get to have the same access. And like you said correctly, someone that is just supplying and not borrowing anything, they are wasting their borrowing power, which means wasted opportunity, and they could just capitalize on that and re-lend their borrowing power to put it to work in the ecosystem. On the other side, there are borrowers that are getting liquidated, so they are in obvious need of borrowing power. And if you just connect these two users, you already can solve two problems on lending markets. And the core idea for the V1 version is to just tackle these problems at once. So lenders that have idle borrowing capacity, they delegate that to the borrowers, and the borrowers can borrow on behalf of those users to just boost their liquidation LTV. That's the core idea. And if you like, we can also jump into some infographics that I just prepared for this call. I think that makes it just easier to understand.
Yeah, we'll get into that. So I think for the why, we're good. People understand, okay, why you guys exist, what can I do with you? I guess my next question then is, credit delegation. To be fair with you, I kind of stopped listening when I start hearing about this thing, because I started hearing about this thing, I don't know, 6 years ago or something, to do some funky stuff. And, those were some kind of weird project that didn't work so well. I mean, they were interesting, but, they didn't go nowhere, like AirDie, or I don't know if you remember all that early experimentation on this kind of thing. It was more like AirDie was something else, but it's been this thing that you hear like as a keyword almost for years, back in early DeFi, and it wasn't really leading anywhere. But I feel like there's been a bit of some development, some breakthrough that allows a protocol like Twyne to exist that couldn't have existed maybe 5 years ago. And I don't know anything about that. So maybe, take a step back. Like, what's the improvement there? EIP or whatever that is that enable the protocols like Twyne to exist in the first place, and how does it work essentially, that credit delegation?
Well, first of all, to your point, probably if we were to data mine early MakerDAO forums, we'd probably find every idea under the sun that has been or will be implemented in DeFi, probably. But to more practical answer to what you just asked, is I think we needed so Twyne CRUD delegation requires having an established lending market to be based on top of. After all, Twyne is a modular protocol. It's not a standalone DeFi protocol. And we didn't have that 5 years ago. I would argue that that lending markets are just entering their maturity phase right now. Like they exploded on the scene effectively last cycle with the DeFi summer and beyond. They managed to they just got out their first full bear market, and Aave is a gigantic endeavor that can't be swept away. And so we kind of have the infrastructure in place to think about building these extra layers of risk tranching on top of lending markets. On top of that, we've also had better toolkits. Twyne, for example, is built on Euler's EVC EVK stack right now, and that effectively allowed us to not have to build everything from scratch. We only had to build custom portions of the protocol we can go into if you want, and so building on top of DeFi protocols just became a lot easier over the years, and especially I would argue this cycle.
Yeah, and so far as I gathered, it's Euler and Morpho, right? It's like where you find what you need to be able to do this credit delegation in terms of the source of the loans.
I mean, we just started on top of Euler. I mean, we're using the EVC, EVK, so it was super easy to
okay. So it's
right. But with the same architecture, we can also plug into Morpho, Aave, Fluid, into all the other lending markets. Like, you can think about it as like 3 layers of our code, and we just need to change the lowest layer in order to plug into different lending markets.
And that third layer to plug in lending markets. So right now you have Euler. It's available on Morpho. Is it like AVV3 kind of deal, or is it more AVV4 kind of deal? I just want to get a sense of where the lending markets are on this regard.
I don't know if I understood the question. So right now we're live on top of Euler. Our next push will be to finalize our integration with Aave v3. Okay. In terms of connections to Aave v4, I mean, there are all sorts of custom hooks that can be used to expand the functionalities of Twyne, and some of these overlap, I guess, with things that Aave v4 is supposedly working on. I mean, it's not launched yet. So, but right now we're focusing on markets with deep liquidity. So Euler was just the simplest one out of the box because we built on top of their tech stack. And the next big player we want to tackle is Aave v3.
Yeah, maybe to add to that, I mean, Aave is not immutable code, so it's a bit harder to build on top of them. But they are also now they're managing $60 billion, so they cannot just change their code like they did in the past. They need to ossify their code base. So now building on top of them is probably a good time, better time than before.
Yeah, it's gonna get really interesting. I think this V4 release, and I don't think we're gonna have a clear situation like a VV2 to a VV3 nowadays. I think it's gonna be more of a UniV3 to UniV4 type of migration. With
For sure.
a
For sure.
long period of coexistence. Yeah.
Absolutely. Absolutely.
Yeah, fully agree. I mean, V2 to V3 was kind of a step improvement, but it's an update on the code. But V4 is something from scratch, so you first need to build the trust into that code base. So let's see how long that takes.
Yeah, for sure. And I mean, the grinding for it right now is on, every 2 weeks or something, you see some audits. So I don't know what something happening on the on V4 code base. So I'm not too worried. All right. So that's for the cool part. And I guess I'd explain also another question that can pop up immediately is like people would expect to see an AVI supported in such a product. So that's good news to hear that you're working on integrating it as well. So we got the what, we got the how. I guess more concretely now, like what type of users come to each side of the market? Uh, how do I come to use Twyne on the demand side and on the offer side? What do you see here? I'm just gonna close the
Yes,
window because rain is starting. I don't know if you can hear it, but just to be sure.
No, we can't hear it.
go for it, go for it. All good on our side. But yes, what kind of users does Twine have? I mean, we believe it will be more sophisticated DeFi power users. Like, it won't be the person that is just discovering DeFi and they first need to learn what a lending market is, and then maybe later on they learn what a liquidation threshold is, and then they will try to understand what we're doing here. So I think that is going to take some time. So to start with, yeah, as I said, sophisticated DeFi users on both sides. On the supply side, it's easier because you just deposit your Euler receipt tokens or Aave receipt tokens. You can think about it as you deposit to Aave, you take that receipt token and deposit that into Twyne. And for the supply side, then you're done. You're delegating all your credit. You are earning the underlying lending market rates plus whatever the delegation rate is on top of that.
Would you describe this LP side kind of like restaking? I feel that would be a good,
Yeah.
because it's kind of the same thing. You're already into something and you are accepting one more layer, but you're also getting one more layer of yield.
Yes.
That's
It's
pretty well.
basically the same thing. Yes, exactly.
Awesome.
You're restaking the receipt token.
Sorry, I just wanted to, because I think it's clear for people, they know what restake is. Yeah.
Yeah. So yeah, that's for the supply side. I mean, there you don't need to be a DeFi power user, to be honest. But if you want to understand the whole protocol, you will probably need to be one. On the borrow side, on the demand side, there are two different use cases. They are either you can use it aggressively or defensively. Well, what I mean by that is you can use Twyne as protection against liquidation. So if you just keep the same leverage as on the underlying lending market, but you boost your liquidation threshold, then you can just withstand more market volatility and you don't need to unwind your position for every market drop. That is the defensive user, but then you can also be an aggressive user and just start looping up like crazy and farming. Let's say you get PT tokens at a 95 to 98% liquidation LTV and you start looping that with like 40, 50x leverage. That is very degen and very aggressive, but you can do it on Twyne because you can think about it as this separate risk layer and only the creditable piece is doing the risk and all the other users are fully isolated from them. So the underlying lending market cannot really do that. But on Twyne, because it's a separate risk layer, you can just allow the users to borrow at these higher liquidation LTVs. So yeah, to summarize, you have this demand side, just deposit, restake, and you're done. And the supply borrow side, there are two different ways. Either you use it as protection, or you use it to just to generate more yield on your loops.
Nice. Yeah, I wanted to start to get visual a bit and just showing the interface for now. So I guess it gets more concrete. So on the supply side, so far there is just ETH, but at a pretty decent yield. So Yeah, I guess this explicits pretty well the kind of restaking dimension that happened here, with the breakdown of the 2 year from the lending, so the Euler side and the delegation, you guys side. We end up with an is almost at 5% on a pretty low. Yeah, we'll talk about the caps, I guess, later. And then on the borrow side, you have several leverage position. You can get this additional liquidation Swiss or LTV for, and depending on the world, the impact can be quite big. But yeah, I guess expressed like this, people are a bit confused. But how to put it like this? I guess the closest you get to 100%, the more 1% is worth. Let's put it like that. So a jump from 85% LTV to 94 could seem pretty unexciting if you just look at it as, oh, it's 9 more percent. But you have to think of more in terms of, oh, I was 15%. Yeah, I was 15% from 100, and now I'm 6% from 100, and you kind of see the difference much bigger there.
Yes, exactly.
In terms of showing on the on the front end, we're also still iterating ourselves and constantly tinkering and trying to figure out what is the best way of showing this to users. But in terms of like the borrower experience, the borrower basically gets to choose their liquidation LTV. If a user listening to this this podcast episode, is used to using a DeFi lending markets, that they'll know that their liquidation threshold is fixed. It's imposed by the protocol. What Twyne allows them to do is to remove that fixed constraint and allow them to change it to their preference. And the trade-off that they take in doing so is the higher a liquidation threshold they choose for themselves, the lower their collateral yield is, effectively potentially going negative, because you're paying the credit LPs who to rent out the borrowing power that you need to tap into that higher liquidation LTV threshold.
Mm-hmm. So yeah, those leveragers essentially are paying for their extra LTV with a collateral yield, and potentially, if that goes negative, even a fraction of their collateral. Get it right?
Yes, exactly. Yeah. We call it internally. It's called in the white paper we call it the siphoning rate, because the borrowers pay the credit LPs through their collateral. So the collateral gets slowly siphoned away into the credit LPs to support their the higher liquidation LTV.
Yeah, so that's also pretty cool. That means on the LP side, the yield is pure ETH denominated yield on top of ETH, right, essentially, with two sources of ETH, but still pure ETH on each side, or pure supply assets.
There's also a big multiplier effect, because I don't know if you noticed this, but like on the screen, the borrow screen you were just looking at, that shows you the quote unquote worst case scenario of what you would be paying in yield to access the maximum liquidation LTV. Then if you look at that number and you compare that to what the credit LPs are making on the earn page, the numbers are pretty small. And the reason for that is due to Twyne's capital efficiency. So you don't need that much extra borrowing capacity to tap into these higher liquidation LTV thresholds. So relative to the full amount of your collateral, the borrower isn't paying that much money. But from the credit LP's perspective, they're actually making a lot more on the assets that they put to use. That's why it's kind of funny. But from our point of view, yes, of course, we have to bring in both credit LPs, like the supply side, if you will, and the borrowers. But of the two actors, the one that we focus more on, that we try to strategize more around, are the borrowers, because for every dollar of supply side credit LP funds, we've got to find another $8 worth of looped up collateral to match it with, to maintain the same yield for the credit LPs. $8 here is an example here because of the ETH vault. It really depends on the underlying liquidation LTV of the assets involved. But yes, there's a big multiplier effect between the credit LP and the borrower side.
Yeah, I guess that's interesting. But what would be the main limit for now? For me now is this cap, this 7 ETH supply cap. So we're almost at cap on this vault, pretty much.
We are, but it's not really. I mean, obviously the caps can be increased, but like if you look at the utilization, it's only 60% utilization right now, right? So of all the funds that are in the credit vault, only 60% of it is actually being rented out by borrowers right now. If it were to be 100% utilized, we could support close to twice as much total collateral in the system without needing to raise the caps. And this is the kind of the weird thing. It's kind of the strange thing about to wrap your mind around Twyne. It's the capital efficiency is really key here, because the even if we were to increase the credit vault to $100,000 to $100,000+, and it were to get filled and used at 100% utilization, that would mean a TVL on the borrower side of over $1 million.
Yeah, so right now with the $30,000 cap on the CLP side, if you as a borrower borrow at the maximum liquidation LTV, you can borrow up to $300,000 or use up to $300,000 as collateral, and that's for the highest max liquidation LTV. If you just adjust your liquidation LTV slightly, if you just increase it by 1%, there are $3 million on the borrower side that can use that CLP collateral. So it's extremely capital efficient.
Yeah, and so that's why people look at the credit vault and they think, the caps are low. This seems like a tiny thing, but in reality, it's like the thing we have to we need to get we have to keep these caps to give us time to bring in do the BD work to bring in the borrowers, because we want the yields to be nice for the credit LPs, and they are. Like the capital efficiency really plays to their advantage, but we don't want to we know, because of what we said before, you don't need to be an efficient you don't need to be a sophisticated player to restake assets in Twyne, right? So that's the easy thing to do in a sense, right? And if we just had incredibly high caps, a bunch of people were to restake their assets, the utilization would drop, the yield that everybody would earn on the credit LP side would drop, and it just wouldn't be good experience for the credit LP. So that's why we're keeping very conservative caps, because first of all, they're more than enough for the borrower capital that we have in the system right now, but we can always raise them as on demand. Like there's no real security reason for why they're this low. It's just for the experience.
Utilization. Yeah, I guess it's I've been going around and preparing project myself, and that's a question you will get. Like I'm almost playing the VC here. It's like, oh, I'm liking your 5% of on ETH. What happens if I drop $1 billion in it? They like to ask this kind of question to essentially kind of understand how your protocol is stress testing over scale. And here, really, there is this concern of maintaining a decent utilization. So it really seems like it will be the tough nut to crack in your growth equation, is how do you find those people actually using that delegated credit? Because the other side seems pretty straightforward. You can maintain decent yield, you can even loop it, or I don't know, find things you can go crazy with it.
So that's why we're focusing, even though like anybody can use Twyne today, we're really focusing right now on more of like a B2B strategy. We want to find big projects that are like, for example, looping staked ETH or LRT tokens that would like to have that higher liquidation LTV to be able to farm the yield differentials even more. Like Twyne would be perfect for that, right? Especially on staked ETH loops, for example, the multiplier effect goes from 8x to 20x. So it's like we would $1 million of credit LP funds would support $20 million of looped up collateral on the borrower side. And like I said, this multiplier depends on the liquidation LTV of the asset on the underlying lending market. So on the looping side, we want to look for very sophisticated players that loop assets on behalf of many users. And on the liquidation protection side, even there we want to follow a little bit of a B2B strategy. Obviously we got to show a track record. We got to show battle test. We got to build trust in our code base. But then we like to think of projects like DeFi Saver would be ideal.
I was about to say yes.
Right? Because like the DeFi Saver has already like the retail distribution, and they already they do a lot of work on automations and just simplifying like the risk management for users on DeFi Saver. They're the perfect project that could tap into Twyne's leverage Twyne's capital efficiency to provide extra value to retail users. And then once we get big, then we can start focusing more on retail specific B2C strategies ourselves. But right now, given our size and given that we're fresh on the market, we're trying to follow more a B2B route.
That makes ton of sense. And Yeah, I guess there are several ways to go about this in terms of integration, because probably guys, but I'm pretty big on the lending aggregation overall. And so I guess this question is more about, it's a bit of a thought exercise, because it's a bit early, but let's say in two years time or something, how do you see Twyne playing into that? I'm thinking, for instance, services that leverage on behalf of user could essentially harness you as an extra line of defense against liquidation, and it could even go in protected by Twyne, certified product. Or you see what I mean?
Yeah,
Um,
for sure.
I'm
I mean,
thinking
so
altitude, for instance. That would be also a potential decent candidate there.
absolutely,
Because
absolutely.
yeah,
So I mean, at the end of the day, like what we're Twine allows, like we said, through restaking, it allows credit LPs to rent out their unused borrowing power. And right now on Twine, the vaults, because of the vaults we launched, you can rent out your unused borrowing power to other people that are using ETH as collateral, but you could be renting out your borrowing power to any other asset, including assets that aren't listed on the underlying lending market. And then once Twyne integrates with multiple lending markets, the receipt tokens from different lending markets could effectively borrow, like rent out borrowing power on a different lending market. And this kickstarts a whole flywheel of use cases, such the main one being interest rate arbitrage across lending markets. So we think of like lending market aggregation in this sense, just kind of like without, like, while keeping the native assets in these underlying markets, just kind of like enable through risk tranching all sorts of other operations on top. And these operations have the great property that if you don't want to like interact with Twyne, you're completely segregated from the risk that's taking place on Twyne. However, you still get the benefits of it because Twyne effectively boosts the utilization of the underlying lending market. So if you could be a lender on Aave and see higher lending rates because of Twyne's success, even though you're not exposed to any of the risks on Twyne.
yeah, that's something I like about this. I was just thinking about it. Ask them the question of what's the impact on the underlying lending markets. But in your guys' keys, it's very easy to figure out that the impact is positive for the underlying, because it's just increased utilization overall. It's creating utilization where there is none. But it's also a connecting thread I found with a project like Altitude, because same thing here. Overall, it's both of you are building infra that are net positive to the underlying infrastructure, and also kind of infrastructure agnostic in a way. I mean, for now, not so much, but eventually, as you add more venues, and I imagine in the UI potentially even you abstract this from the users, or it depends, but there will be this. Like Altitude is doing a bit this curation layer of directing users to one underlying protocol or the other, but this direction won't be done. I want to say ideologically, like, oh, I love Avi, let's send all the funds, but more, okay, the best rate for the users obtain with this flow, so we're going with this flow.
Yeah, no, 100%. I mean, we think that the lending aggregation game will probably play out the same as for AMMs. I mean, the aggregator started by simply routing through the vaults to the different AMMs, and that is a race to the bottom on fees pretty quickly. Like, if the moment there are two aggregators, no one can charge anything anymore. So you need to provide additional value to the users. For AMMs, it's private order flow, it's intent, it's all these different ways of providing more value. And in lending markets, you can also provide more value like we do right now, like Altitude does with borrowing and deploying to DeFi. There are just all these, like, if you're already aggregating your users, like, aggregate the value as well and provide more than just on the underlying protocol. So that's how we're thinking, like, aggregate the users properly to then aggregate the lending market properly, while always trying to segregate the risks where possible.
All right, makes sense. What did I have more? I guess I have one more thing. I get a good sense of how it works, how it came to be. The fees we discussed, we've seen a bit in the UI I shared earlier, how it works. So paid in the collateral assets. I guess what would be, we talked about what's next, But yeah, how do you really scale that yield above? I'm just okay. I get the overall plan. You find there is a multiplier between the supply side and the borrow side, so you don't need so much, but you still need a bit on the lending side to attract the borrowers, especially because all the situations I have in mind is more armor stuff. Like, let's put it like this: like I'm using Twyne because I know there is a ton of unused borrowing capacity here that I can tap into in case of needs. Like, I see this flow as a really good flow, but the problem is this flow requires there is a ton of borrowing capacity available on Twyne to begin with. So, like, what are the intermediary steps?
I mean, I would maybe add that there doesn't need to be a ton for this use case, and maybe to also like just add to the start with, this is our V1, and we have like 4 other use cases that we can use borrowing power for. We can get into that in a second, but I would rather put it as a good thing. I mean, right now, in order to boost your liquidation LTV from 85 to 90, you need about 5% in collateral, and I mean, that is great. Like, instead of having to seed a new market, like people also ask us, okay, why don't you just create a market on Morpho or on Euler with higher liquidation LTVs? But then you need to seed that market. You need to find lenders. You need to find lenders of the other asset that you want to borrow. And these interest rates will be way higher. And we don't have all that stress. Like, we inherit the interest rates of the underlying lending market. From day one, our credit LPs, they earn the underlying rates. And whatever we add on top of that is yield on top of that. So that's the kickstart problem there is a bit smaller. And on the borrow side, I mean, it's amazing that you only need to pay a small fraction of your collateral in order to protect your whole loan, right? So right now, the liquidation incentive is 5 to 10% on your complete loan, while on Twyne, you can right now borrow at a 1% higher lower APY, and you can protect your whole loan and just keep the whole position open for 10 years, and then you have the same cost as a liquidation incentive. So I wouldn't necessarily put it as a big problem. Like, maybe GTM wise and showing big protocol numbers is not the best, but the plan is to just layer multiple use cases on top of that. So one other thing that we are allowed with unused borrowing power is to just inherit the other users' positions. So a liquidator that has idle borrowing capacity can just absorb liquidated users into their position and make, again, use of the idle borrowing capacity. And then, like, the plan is to just add multiple of these to then, as I said, have the underlying lending infrastructure plus all these secondary agreements on top of that.
Mm-hmm.
Yeah, I want to stress the point about the available liquidity, because you mentioned, Bryce, you mentioned before the you put on your VC hat and you said, oh yeah, but what if I deposit $1 billion ETH into the credit vault? What happens to the yield? And the yield would obviously go to zero. The same problem wouldn't exist on the borrow side, in the sense that if you deposit $1 billion, $1 billion ETH into a collateral vault, I mean, yes, you would put us in a tight spot where we need to increase the caps on the credit vault and convince creditors to come in. But in theory, if you wanted to go on Twyne right now and not boost your liquidation LTV, just you want to use the liquidation LTV of the underlying lending market, you could deposit as much as you want and you could borrow as much as available on Euler. So in that sense, this goes to what Taulant was saying. Like, we didn't have to build up this liquidity. This liquidity is already there. You can tap into it right now. If you want to deposit $1 million of collateral on Twyne, not pay anything to any creditors, but you just want to use Twyne as a proxy to borrow from Euler, you can do that right now. We're just kind of like focusing on offering this extra like risk adjusted use case on top for creditors to rent out their unused borrowing power, and for borrowers to use it when they want to use it, if they want to use it. Because in the defensive case that Taulant mentioned earlier, where let's say you're close, let's say you're using ETH at 85% liquidation LTV on Euler, and you're about to, you're in a leveraged position because it's the bull market, right? So your thesis is long, right? The market tanks or drops 20% over the course of a month, like we just roughly saw in the past month. So now you're close to liquidation. So now you have two options. You either unwind the position, By the way, if you've been holding this position for a number of years, you're going to have to pay a big capital gains tax on that if you unwind your position, right? So, or alternatively, you risk getting liquidated, and if you get liquidated, you could get liquidated. And you're gonna basically, it's equivalent to unwinding your position at a market low and paying a worse price for unwinding your position. Or you come onto Twyne and you pay an extra. You basically sacrifice a little bit of your collateral yield to have a higher buffer to getting liquidated, and that allows you to stick through your position without unwinding it. And if your thesis is long, the market's going to turn around at some point and go in your direction.
Yeah, no, that makes a lot of sense for me. This like liquidation buffer, saving the position, and I guess the other use cases come a bit more with time and see it in the one.
Yeah. And you don't have to pay, but like the point I want to really make is that you don't have to pay for this extra liquidation LTV. Let's say your position is safe and you're not about to be liquidated. You don't have to pay for that liquidation LTV. You could have the liquidation LTV of the underlying lending market, meaning that you don't pay anything to any creditors on Twyne. You basically inherit the same exact risk profile that you would have in a position on Euler. But if you're ever stuck in a pickle, Twyne gives you this one-click option to pay to have that higher liquidation LTV.
Yeah, and it's well done in the UI. This whole like boost orange or red section. I don't know which color it was, but you can see it pretty clearly. So yeah, I guess that makes sense to just drive some volume through Twyne that is initiated through Twyne, not using yet the feature because they're not in the bonus LTV zone essentially with their borrowing, but they are here and they know that they have more buffer in case the market was to go south. Okay, yeah,
Yes.
that makes sense to me.
And best case, you have an automation to just automatically adjust it. So if you don't need it, you don't pay for the extra credit, and if you need it, you will gladly pay for it.
Yeah, that would be definitely a good add in DeFi Saver then, like a kind of one-click option. And I'm sure there will be a lot of takers.
Yeah, for sure.
They are bullish on it.
Nice. You mentioned earlier, Taulant, you have some visuals, some diagrams as well. You wanna shoot? I figure that's good of a time.
Yes, I can share my screen maybe.
Yeah, you should be able to.
Okay. I mean, to just get a bit into the mechanics, you can see it?
Yeah, we got it.
Okay, nice. So yeah, to start talking a little bit more about the architecture. If we just look at the left side, there's Alice, and Alice is depositing the collateral into the underlying protocol and then restaking it into the credit delegation vault. Alice gives up the borrowing power, gets extra yield in return, and basically earns more yield. That is the earn page that you already saw on the app. For the borrow page, it's just the right side of it. Bob deposits into Aave. They have an isolated borrow vault. So the credit vault aggregates all the users into one vault, and then the borrowers all have isolated vaults themselves. So these isolated vaults, they reserve credit from the credit delegation vault, which then gives them a higher liquidation threshold. And then Bob, again, just borrows the debt from Aave. And I mean, they could just directly use it on Aave, but then they have a lower liquidation threshold. So this is the overview of just the Twyne protocol. It's these two vaults that allow the users to either earn more yield or get a higher liquidation threshold, depending on their needs. This makes sense until here, right?
Yep. I mean, it's high level. It's pretty easy for use case for once, I guess it's more like understanding the interactions of it and what it means in practice is harder part here. There is no crazy math or nothing involved. It's not a new way of concentrated liquidity or I don't know what.
No. I think we can skip this part. I think one.
Oh, there is some fancy new math. You just didn't show it to me.
Calling this fancy new math is an overstatement.
Yeah. Okay. Yeah. No, that's
I
pretty
mean,
simple.
yeah, Daniela wrote a whole white paper that is full of fancy math. Like we can get into that, but I think not this time. But yeah, I think the one important invariant is this one. Daniela, I don't know if you wanna maybe give us a quick
Yeah, no, I mean it's
overview.
pretty straightforward. Like I mean, like the entire math of Twyne boils down to a very simple statement. So Twyne basically deals with two accounting, like two accounting frameworks, and it has to like make them be consistent with each other. So the first one is the standard accounting framework. Like you're a borrower, Bryce, you want to have 90% liquidation LTV. We give it to you because we do this fancy magic with creditor funds, right? And if your LTV ever goes above your chosen liquidation LTV, you're liquidatable, right? This is the easy bit. The hard bit is that in all of this, you're borrowing from an underlying lending market, which has no notion of Twyne, who is the borrower, who is the creditor, right? The lending market basically just allows their own receipt tokens to tap into borrowing power. And what they see is a collateral vault. Twyne's collateral vault is effectively this like meta user as seen by the underlying lending market that has the collateral from the borrower, the collateral that is rented from the credit LPs, right, and the outstanding loan that the borrower owes, and the LTV of this position, this net composite position, has to be less than the liquidation LTV of the underlying lending market. So basically, what Twyne's math boils down to that at the moment in which you, Bryce, become liquidatable, in other words, your loan size is equal to your chosen liquidation LTV on Twyne times the collateral that you own, right? In that moment, your LTV as seen by the underlying lending market has to be less than or equal to the liquidation LTV of the underlying lending market, considering the same outstanding loan, the same collateral, but also the creditor collateral that you've effectively rented out. And this less than or equal can be made exact in the case that right now it actually is an equals. It basically when a user becomes liquidatable on Twyne, the combined position becomes liquidatable at the same exact moment in the same exact block on Euler right now. This is because there's a buffer that we can set. There's a global parameter that we can set. Right now the buffer is set to 0 in the sense that there is no separation between when a user becomes liquidatable on Twyne and when a user becomes liquidatable in the underlying lending market. And we can do that because of the properties of how liquidations work on Euler. This is a very underlying lending market specific. Every lending market would have their own buffer policy set. In general, though, there's a buffer that we can set, and that basically says when a user becomes liquidatable on Twyne, we have a buffer in price space that the price needs to keep moving against the borrower's interest before the composite position becomes liquidatable on the underlying lending market. And the reason why this is important is because if the position becomes liquidatable on the underlying lending market, remember, the underlying lending market has no notion of Twyne, borrower, creditor. The underlying lending market will just liquidate this composite position, right? And once it liquidates this composite position, there will be, in general, some collateral left over and some outstanding loan left over, depending on what was the liquidation incentive, what was the closing factor executed by liquidators on the underlying lending market. These Twyne agnostic liquidators, right? And when this happens, then Twyne has to basically reaccount what is left over, what belongs to the borrower, if there's anything that still belongs to the borrower, and what belongs to the creditors. And obviously, this is called post fallback accounting because getting the meta position liquidated by the underlying lending market, we call it the fallback liquidation. It's not the preferential liquidation policy. Twyne always tries to liquidate at the Twyne level, but it allows being liquidated on the underlying lending market level in case of an emergency. And after this happens, we have to basically resurrect the position and basically lock in the losses of the parties involved. And when this happens, this is the moment where potentially the credit LPs could lose money. It's not guaranteed that they will lose money. Again, it really depends. And this is the white paper is basically all about this. It goes very deep.
I know the drill pretty well. So I was about to ask, just to be explicit with everyone. So it means all depositors here that are restaking, as we were saying earlier, also have a third source of yield, but a dangerous one, which is the liquidations. So they can have the total balance of deposited asset go down because they will need to fuel some funds for those liquidations, right? But in exchange, they will get this borrowed assets. So in this case, we're talking what wrap EEs, Bitcoin, things like that. And in that sense, it's essentially very similar to a liquidity stability pool exposure. In
Yeah.
the sense that, I park, well, in liquidity you're parking stablecoin, but I park stablecoin, I get a predictable, roughly stable base yield. And then on top of that, I get a very unpredictable, very spiky, very, who knows what happened, but most of the time it's pretty good, but I can never tell you for sure. And I got some.
I would argue it's a little bit more predictable than
Okay.
liquidity in this example. And the reason for this is because if the liquidation takes place on Twyne, because the whole point of having a buffer, having this less than or equal sign in this equation that we just showed you, is precisely to give liquidators time to liquidate on Twyne before the meta position gets liquidated, the composite position gets liquidated on the underlying lending market. And if the liquidation takes place on Twyne, then the creditors are always made whole. Because the way liquidations work on Twyne is that someone effectively, like, well, there's a couple ways of doing it, but the general way that we're trying to like become like the main one is that a liquidator can just post some extra collateral, and by posting extra collateral, they can just inherit the position from the borrower. And by inheriting the borrower's collateral vault, they inherit their collateral, they inherit their outstanding loan, and they inherit the credit LP funds that they still owe to the credit vault. Right, and so then the liquidator will want to unwind the position in some form to capture their profit, because they're getting paid an incentive for doing this. And in unwinding their position, they will release funds back to the credit vault, and so the creditors are made whole. It's only when the fallback liquidation takes place. In other words, when the underlying lending, when liquidations on Twyne completely fail, and like nobody wants to liquidate the position on Twyne. Not even the credit LPs themselves, because the credit LPs themselves could trigger a liquidation, because effectively the collateral that they have in the borrower, like used by the rented by the borrower, they could technically use this collateral as extra collateral to inherit the position and make it safe for themselves. Even if nobody does this, then yes, the underlying lending market will be forced to liquidate this position. And only then, after this liquidation, depending on the liquidation incentive and closing factor executed by liquidators on the underlying lending market, will credit LPs maybe see a loss.
All right, yeah, that's pretty interesting. So I understand better now what you're saying. This is like a secondary and less preferable path, going down to the complete unwrapping, unfurling of the position on the lending market. And yeah, so if everything is contained to Twyne, the depositors remain in the deposit asset essentially at all times.
Yes.
That's a big one too.
I mean, I have some pretty plots if you want to go into the losses there, but we can also skip that.
Yeah, I mean, it's okay. I think it's pretty early anyway. So have you seen, how far have we gone in the wild so far? Have you seen some deleveraging of the Twyne part? Have you seen some actual full liquidation of the whole thing, the base plus the Twyne?
We've seen both. We've
Nice.
seen both Twyne liquidation. So one of the reasons, okay, so like I mentioned before, right now on Euler, Twyne is launched with a buffer of 0. So the moment a user becomes liquidatable on Twyne, the composite position is liquidatable on the underlying lending market. There's like effectively there's a race condition. You can either liquidate on Euler, or you can liquidate on Twyne, and this was done on purpose for 2 reasons. One, because to showcase the fact that the way liquidations work on Euler is kind of like perfect for the way Twyne works. Euler effectively charges a dynamic liquidation incentive, which is a function of how high the LTV of the borrower position is above the liquidation LTV. So basically on Euler, when you reach your liquidation LTV, your position is liquidatable, yes, but the incentive is 0. There's no incentive to liquidate you exactly at the liquidation LTV. If then nobody liquidates you, because no liquidator is going to make any money out of liquidating you, so why should they liquidate you?
They let it sit for a while to accrue potentially different.
Exactly.
Yeah,
so if you sit in this position, and now let's say the price keeps moving against you, and now your LTV is 1% above the liquidation LTV. Now the liquidation incentive is 1% on Euler, right? And then liquidators decide, is it convenient for me to liquidate you for 1%? Yes or no, and so on and so forth, right? Meanwhile, on Twyne, we give you a liquidation incentive that is not 0 from the moment you become liquidatable. So we want to see this race condition, because rational liquidators should choose to liquidate on Twyne rather than liquidate on Euler, because you're going to get paid more for liquidating on Twyne than liquidating on Euler. That's the first point. The second point is, I don't want to go too much into the details of how the credit LP losses work as a function of the liquidation incentive and closing factors, but the performance of liquidators on Euler is that they generally close at 100% closing factors and relatively low liquidation incentives, and these are heuristically precisely the scenarios where credit LPs will not lose money, even if the composite position gets liquidated on the underlying lending market. So we wanted to launch in this way because we didn't want fallback liquidations to be a theoretical construct that you see in the white paper and maybe it gets hit one day. Maybe, we wanted to showcase that this is a fundamental mechanic of how the protocol works, and we launched with no safety buffer on purpose so that we could see it in action right from the start. And in the last liquidation cascades, I mean, obviously we're not that big right now, but we did have liquidations during the liquidation cascades that took place in the last week, and we had a mix of both. We had liquidations on Twyne and liquidations on the underlying lending market.
Yeah, nice. It's small but fully tested, essentially. So that's better than most pitches. Yeah, I had a bit of let's say a news-related question because when I see a mechanism that I like, I want to see it everywhere. And for the quick story, there is Machina.fi that is launching today. Pretty unrelated protocol. It's mostly vaults, but they do have this interesting concept. To put it simply, so they're launching today. You can deposit into the protocol, and you're being paid your yield. It's vault on ETH, on stable, whatsoever. But as you deposited, you're accruing point over that early period, and at the end of, I think it's 1 month, those points essentially give you access to be able to invest in the token on equal terms with the VCs. So, I found it pretty cool. It's like, oh, you like the project? You can either, write your check as a VC, but maybe you're not a VC. Well, you can just put your freaking ETH or stable in that protocol, sit there for a while, and that will give you access to essentially same terms there. I really like this way of doing things. Maybe not this one for you guys, but essentially, like, what's your vision longer term? Because obviously there's going to be a token. How does it connect to the incentivization of the whole thing? When have you started to, are you really like product? And that's receivable answers as well.
I mean, there are different voices in the team, let's put it that way. But in my opinion, it doesn't make that much sense to think about a token before having some sort of product market fit. Like, probably the matter of useless governance tokens is over. So let's provide some utility first, and then we can launch a token and think more about those mechanics.
Yeah, and I think the infra play is a really good fit for that as well. Like where you can already provide a lot of value without needing to embed a token into your system. So that would make sense to me.
Yeah, I mean, you can think about what we're doing as permissionless emote on top of lending markets. And I mean, if you look at the governance forums of big lending markets, they all just want to have emote, and they literally fight they fight for it. So we can all fight in a permissionless way. So yeah, we think that's a pretty good, pretty bullish GTM strategy that may allow us to not overspend on growth at this early stage.
Yeah, it's another big trap for sure. For sure. All right, I think that was a pretty solid overview. Showed me the graph and everything. I don't know if you have anything else you want to add, and if not, I guess we can keep it like short, sweet, under 1 hour. But I think it's a good overview. Maybe just so we talked a bit about future stuff, but more practical future stuff. Okay, I like Twyne. What is coming in 3-6 months? Not the long-term plan, but really like the next releases that you can tell me of.
I mean,
Daniele is like, I'm sorry, bro.
No. I mean, that's a great question.
I can maybe show you like what will come in the next weeks, and then we can go for the next month. Okay.
Yeah.
Okay, deal.
So like you said earlier, like here you can see how many loops you can do
Oh wait, are you still are you sharing something?
Oh, sorry.
Because I don't have it just to make sure. Yes, okay. Let me just add it back. Okay,
Sorry.
we're good to go. We're good to go now.
Yeah, nice. I just want to show what we are adding next week, most likely. So here you see the max loops over the liquidation LTV, and like you
Nice.
said,
Yeah, perfect
before,
illustration of this. I was saying every percent
exactly.
being more valuable.
Every percent like just allows you to loop up way higher. So if you are at 90%, I think it's about 10x. If you're at 95%, you are close to 25x loops. If you go to 99x, you can do 100 loops. And I mean, we are in the carry trade meta, so you can squeeze out a couple more loops. That is in the short term. I mean, it's built. We just need to launch the balls with the right tokens. And I mean, for 6 months plans, I mean, right now you saw the infrastructure, how it looks like. You have all these different vaults with different players, but we wanna kind of put everything into one contract and one address and have one big meta address where all the users are combined into one position, so that you just gain all the efficiency from like a big network. So right now, for example, if you wanna liquidate a position and distribute it across all our users, you would need to send it across thousands of collateral vaults, which just isn't feasible from a gas perspective. And if you aggregate everyone into one address, you could liquidate someone by burning their shares, and then the rest of the tokens would be separated across all these users. And that's, again, one use case, but there are like 20 of these use cases that you can just simplify it way more.
If I can add a little bit to this one use case, because we call this internally the meta account use case. The idea here is to introduce passive liquidators, give the optionality of having passive liquidators. For two reasons. One, because they create an extra potential avenue of yield for people that are willing to absorb these positions, because they basically get to inherit liquidation incentive in a way that doesn't necessarily subtract value from the protocol. Like a just-in-time liquidator is not providing TVL; they're draining TVL from the protocol, right? So if you have users on the protocol that are willing to absorb the liquidation and keep the money there, that contributes to TVL. Think like you mentioned before, the stability pool on liquidity. Like that's the classical example. The other thing that passive liquidators provide is, because they are not just-in-time liquidators, they're not immediately reacting to the price movements. They're not in the middle of a liquidation cascade. They're not necessarily dumping the distressed asset like a just-in-time liquidator does to make the liquidation worse. Last but not least, the act of signaling for passive liquidations behaves like some sort of yield-bearing limit order. It's technically not a limit order because it doesn't necessarily trigger with price.
You don't choose your price at which it triggers
exactly.
that.
You should, like, it triggers.
It's a Russian roulette limit order.
Yeah, it's like it depends on the liquidation cascade. But what we can do is, and someone still needs to trigger the liquidation, right? So that needs to be an active market player. But what we could do is we could try distributing as much of the liquidated position as possible to the passive liquidators on the protocol before giving the rest to the just-in-time liquidator that is triggering the liquidation on the spot. And we think this is going to be value additive for our users, and so we'd like to see this. And to make this happen, like Taulant was saying, we're redesigning the architecture of these two vaults. Like right now, we have this collateral vault and the credit vault. The collateral vault can borrow from the underlying lending market, and it can rent borrowing capacity from the credit vault, and the credit vault can rent its borrowing capacity to a collateral vault. We're going to build a new vault that is effectively like a merge of these two vaults, such that you can coalesce multiple users, still respect their accounting choices, still respect their choice of liquidation LTV, while also making all these liquidation policies a lot cleaner to execute on a smart contract.
Yeah,
like a singleton essentially for your whole.
Kind of like a singleton. That was the key term at our recent offsite, actually. Yeah.
Everybody's going singleton.
Yeah, we can do it as a singleton, correct? Yeah.
You can think about Twyne as just this one big accounting trick. And if you think about it that way, there are many things that you can derive from that.
Yeah. And then this is like 6 months down the road. You said only 6 months, right? We're not allowed to go past.
Yeah, like next. Yeah, that's good.
We'll stop at 6
and
months.
Chain and asset-wise, are we gonna stay with ETH supply, ETH denominated in asset mainnet? Are we talking some L2s? Are we talking some stable, some Bitcoin? Who knows?
Yeah, I mean, yield on Bitcoin is the holy grail. So I think if we can deliver that, people will gladly take it. Like we said, I mean, it will be BTC, it will be stables. You'll have all the carry trades, all the like pendle tokens. I mean, if you are doing them at 10x, you will love them at 40x. So, and yeah, also staked ETH, all the different LRTs. Like we are only limited by the underlying lending markets assets available. Like we can launch those vaults without a problem.
Yes, ton of options to choose from. It's mostly a matter of finding the right one to
To
fit the
work
need.
together
Yeah.
with. Exactly. But yeah, I mean, yeah, like you can look at these other forums who's asking for permission emotes, and we can deliver that to all of them. So, and regarding chains, I mean, we started on mainnet. Let's see how that goes. And not really looking somewhere else at the moment, but we'll see how adoption goes. I mean, on it's just easier to get your new user flow on layer twos.
Yes, yes. Especially, I don't know, but for this kind of stuff, experimentation, I like to do it, layer two Zama testnet. So it's it's good to have that.
Exactly. That's how we treated base. Like, I mean, who's using testnets nowadays? Like, just use like use a cheap layer two and tell everybody that there was only one audit, there was not more than that. So don't ape all your life savings into the protocol. That's how we started our private beta.
Yeah, nice. All right. Well, I think that was a good picture of Twyne, what you guys are doing, why you exist, what can we hope. Uh, so yeah, I hope the show was enjoyable for you guys first, informative for the listeners. And again, it's a first edition, so I'll probably refine things as I go. But I'm glad to be back into the fray. It's for me, it's the best way to learn. Like I could have done this statistically in my corner for an hour, and probably I would have reached about a fourth of the understanding in the same amount of time that just discovering, voicing it with you guys. And so I hope other people learn things as well, connected some dots. That's kind of that's the goal of the game here.
Amazing. Also, thanks so much for having us. I think you asked the right questions and put on the VC hat at the right times.
And it was an honor being on your first episode.
Yes, pleasure to have you guys for this first one, and yeah, see you for the next.
Ciao,
Thank